Hello and welcome to the Rules of Investing. My name's James Marley and I'm going to be your host for the final 2 episodes of 2023. My guest today is Ben Griffiths, founder and portfolio manager at Eley Griffiths Group. Eley Griffiths Group was founded in 2003 and has built a strong reputation as a specialist small companies investor over that time. Ben established his credentials as an investor at ING and BT Financial Group, which is the breeding ground for what have become great investors, names such as Kerr Nielsen, Crispin Murray, and Paul Moore. Today, Eley Griffiths Group has a 7-person investment team specialising in emerging, small and mid-cap stocks and manages in excess of $1.6 billion in assets under management. Eley Griffiths Group's flagship small companies fund has compounded returns at 9.38% per annum since inception, which is 4.29% ahead of the benchmark. Ben, I'd also note over the past year, you've managed to generate a positive return when the small cap index is down roughly 5%. Welcome to the show, Ben, and congratulations on your 20-year anniversary.
James, thanks very much for that warm introduction. It's great to be here.
Now, I want to chat about the big picture and specifically in the environment that investors will be facing as we head into 2024. But before we do, I'd love for you to give readers a download on how you use the macro factors as an equity investor. We often hear stock pickers talk about the fact that they only focus on company fundamentals. However, I've been an avid reader of your quarterly letter that draws on a range of factors from macro to technicals and other indices. So Ben, as an opening question, I might hit you with, what are 2 or 3 indices, data series or technicals that you reliably turn to get your bearings on markets? And importantly, what are they telling you now?
Well, that's all quite reasonable, James, and you're right. We do use, and I've been drawing on macro elements in my preparation for portfolio management and my appraisal of the market for a number of years. I think you need to set the backdrop and for where the stock market is trading, and you need to be aware of the pressure points before you can then work out which sectors are likely to perform and then build a portfolio from that. I mean, the first thing I would typically do is before I look at when I'm assessing the health of the stock market, I want to know how credit spreads are behaving, and they're a great risk barometer. When credit spreads are elevated, that gives rise for angst and some concern, and that has a direct bearing on risk assets. Well, in the case at the moment, credit spreads are quite benign. They're not as low as they were, but they're probably closer to normal ranges. So it sort of is the first indication for me that the water's safe to swim in, if you will. I like to look at investor sentiment. I've been a student of investor sentiment since I started in markets. I crave front pages. I look for adverse, either excessive ebullience at the tops of markets and excessive bearishness at the bottoms. And so I like to measure sentiment, and probably the easiest one for investors like myself and I guess some of the listeners is the AAII series in the US, which gives a direct print on investor sentiment, and as we talk about the markets on our pod, we'll discuss how extreme that setting got back in October. So I look at investor sentiment as an important precondition for whether stocks ought to be bought, ought to be sold. I've mentioned the credit spreads, and then as you also pointed out, I'm somewhat of a fan and a student. I'm still a student, believe it or not, of technical analysis, and I always want to know where the primary trend is on a stock or an index, or a commodity for that matter. I want to know where the primary trend is and whether there are any indications of exhaustion, or whether the trend is suggesting that investment with the trend is the way to go. And there are various patterns that we haven't got time to discuss today, but it's generally investing with the trend. And for me, the 100-day moving average, or the investment line as it's often known, is probably the best trend indicator you can use as to whether markets are going up or markets are going down. So they're just a couple of samples. They're the sort of some examples of the tools that I would regularly look at before I start framing an opinion of whether stocks we can buy stocks or whether we should be sitting in cash for a while.
It's interesting you mentioned there the front page of the newspaper and what's being reported in the press. And when I was doing some background reading in preparation for our chat today, I jumped on Bloomberg, and there were a few headlines that jumped off the page for me. The first one questioned how low the Fed will go in 2024. And the other headline was that Bitcoin had rallied 142% in the year to date. Those two headlines are quite a big shift in the narrative compared to what we faced just 12 months ago. And so I put the question to you, is risk back? And do you think that we've seen the peak in the current rate hiking cycle? I look at Bitcoin as a proxy for risk, and, how low can they go is quite a big change.
I think risk is back. Risk is back, but in a measured way. I think that the whole situation's changed late October. That's when I guess when the Fed came out and basically presented a hawkish hold on rates was how I took the rhetoric, and the market took it so as well. What we have is the beginning of, or we're underway, I should say, with a pause rally, and a pause rally is typical at this stage when a central bank decides it's probably done on hiking, as I think most will agree the Fed has done. And those pause rallies have plenty of juice in them normally, and if history is any gauge, they can go for up to 9 months. So I think we've got a pause rally underway. I think the investor sentiment that I referenced a minute ago, we had that AAMI survey printing net bullish reads at about 21% in the early days of November. That told me that when you get sentiment readings that low, the market is set the wrong way. And then in the middle of November, I got especially excited when I noted on the NYSE we had a very rare 10-to-1 up day, 10 stocks up for every one stock that fell. You rarely see that. When you see that off an important low with volume, you get a 10-to-1 up day. I'm not saying to the listeners you can take that to the bank, but what I'm saying is it's the sort of confirmation I like to see ahead of getting a little bit enthusiastic. So I think risk is on. You mentioned Bitcoin. That's a great arbiter and a great barometer of whether risk is with us or not. And you're right. Some very sharp moves in Bitcoin. So risk appetite's back on. Have a look at the meme index, the meme ETF, which I keep a close eye on, that trades on the NYSE. That's up 50% this year. That's had a rocking great time since late October. And non-profitable tech's another benchmark, another little index that I follow off Bloomberg, and that's absolutely powering. So I'm not for a second suggesting the lunatics are out of the asylum. But what is happening is there's been some stability, and I think sentiment is such that you can sketch out a constructive path forward for equities, certainly for the next I'll say 9 months, But certainly I think there's going to be a buoyant time ahead for us.
I imagine the meme index wasn't something you learnt back in 2003, Ben.
Look, I'd never heard of a meme in 2003, but certainly. They are a feature of the market, whether one approves them or not. They're a feature of the market, and you saw GameStop the other night had a big move as well. I mean, that's another classic stock that gets bombarded by the Reddit mob. So all those things, they sort of can point to froth, but I think at this stage they're really pointing to the return of animal spirits, which are generally pretty positive. So not getting too carried away right now, but suggesting that. But the conditions are reasonably fertile for a rally.
You mentioned before that day, I think it's the 30th of October, when we saw markets really rip high. That whole week was really positive for equities. Is it your take that that's when investors became comfortable that inflation was no longer the major concern or the fight that central bankers had on their hand?
I think that's dead right. That's exactly what happened. And that, of course, those sentiments have been building for a while. It's just all of a sudden the market twigs and away it goes. It's funny when it comes to risk and liquidity. It can be very negative and there's no liquidity about, and then it just seems to turn on something that gets said. It turns on a broker strategist report. It turns on something on the front page of the paper, and all of a sudden it's on, and you wonder 2 weeks ago, how could things have been so bearish 2 weeks ago? So I think we've gone through one of those moments where the planets lined up. At that time, I've mentioned the hawkish hold. I've mentioned credit spreads. The term premium started coming in fairly aggressively around that same time. The The Bank of Japan announced it was going to stand off yield curve control. There are a whole bunch of things that literally brought in a U-turn with stock markets, and away it went. So, yeah, quite amazing. They do happen as quickly as that, and often there can be no apparent logic or reason to them. But that's how markets behave.
Okay. I'd like to dive into what you're seeing and hearing on the ground. And if we talk specifically about the local market, we've talked about the fact that risk appetite has been exceptionally low for some time. The IPO market's been very quiet. Is the phone ringing yet to book you in for IPO meetings in early 2024?
No, it hasn't started yet. And I just thought I would make one comment too, James. A lot of talk about the smaller end of the market where my business plays and where we've made our bones. That part of the market has been somewhat dormant and under pressure. And it's not just the Australian small cap market, it's globally. Appetite for small companies, and that's whether that's in primary demand for IPOs, as you're talking about, or secondary raisings, or even just the conduct of the market. Interest in small companies has been wanting. The MSCI World Index and the MSCI World Small Cap Index normally move in step, and they got immediately out of step, and the small cap benchmark plunged and sold off right at the time the Fed hiked rates last March. So that was the immediate divergence point. And since that point, small caps globally have struggled. So my contention would be, as the market swings around and decides that we've seen the last of the hikes, and perhaps if the betting's right, and we've seen 130 basis points of rate cut expectation is already factored in US bonds from about March next year, that should be positive for small caps of all ilk globally. Now, with that will come to your question, and I apologise for the long-winded approach to the question. With that will come the restoration of IPOs, the interest in IPOs. We've already seen in this last week alone a number of equity transactions in the Australian share market, whether they're fresh equity raisings for asset purchases or whether they're founder sell-downs. Those transactions have been reasonably well received. That's a sign that, again, the spirits are awakening. So I think IPOs, that's the next iteration. There have been a couple of IPOs in the last 12 to 18 months that have been forced on the market, and I mean that. They've been forced on the market, and they've performed fairly poorly. One or two have fought back and got above their IPO price, but most have wallowed. The mood hasn't been right. The appetite hasn't been right. But I think it feels to me like that's set to change. So I haven't been sounded out. It's a bit early. It's a very seasonal thing. So I think IPOs now, if you have an IPO, you're not doing it now. And maybe March is when they come back on. Now, just because it's the other side of the reporting season, people assume, oh no, we'll have them penciled in for the first week of March. I can tell you, when the market gets moving, IPOs and deals will happen in the middle of the reporting season. They'll happen the end of January. They'll happen whenever the deals need to be done. So, but we're nowhere near that yet. So I think it's all fairly cautious. It's all fairly sensible right now. So we'll have to wait and see. But no, I'm not being inundated. But there were a number, Jimmy, to pick you up on that point. There were a number of IPOs that were slated for transacting and listing before Christmas that have now been pushed into March. And I think a couple of them would have gone quite well in any event. So they'll be extra well sought after in March, or certainly pre-June. I think pre-June is how we should be thinking, pre-June 24.
Yeah. So I'm keen to dig a little bit more into what's been happening in small caps. And we've seen that small caps have lagged their large cap peers for quite some time. And I've had some of the investors that we speak to saying it's as bad as they've ever seen. For someone that's been investing in small caps for the best part of 30 years, keen to know, what's your take on this divergence? What do you think is behind it? Is it structural or cyclical? And what will it take for it to turn? Yes,
well, it isn't structural or secular. It's certainly cyclical, and small caps will sort of oscillate around being more expensive than big caps, and then small caps will be cheaper than big caps, and that is all an outworking of the mood of the market. Right now, the small cap part of the market's at about a 17.5 times PE, and that's about an 8% discount to the large caps. The 10-year average is about that. Maybe it's closer to 10%. So we're broadly tracking where we should be. I mentioned interest rates, which have had a heavy bearing down on sentiment, and rightly so, and we've seen that play out. What we've also seen has been an earnings downgrade cycle that's been running concurrent with that interest rate setting. We've had 18 months of downgrades in the small ordinaries. It's been quite extraordinary, and that has also contributed to the bruised sentiment that you alluded to. But how about the recent AGM season? Why don't we talk about that very quickly? That came out, that wasn't too bad, in fact. And we had fewer negative surprises than we've had in previous reporting seasons or AGM seasons. And we had more upgrades versus downgrades by the time we'd finished with the AGMs. I'm just wondering whether is that somehow signalling that we've come to the end of the downgrade cycle. It's been 18 months of bruising. The AGM season suggested there's perhaps a little bit more resilience out there than we might have given credit for. Now, there's some obvious hot spots, and consumer discretionary, if you're in the apparel business, you're probably doing it a little bit tough. But if you're Beacon Lighting or Nick Scali, you might be faring not so bad. So we'll see. It feels like the consumer is still under some pressure, and that will be probably on show in the results we see in February from the companies. But I just wonder, as an index, as a collective, whether we've seen perhaps the worst of the downgrades from the small companies that we can invest in. Well, we're on the lookout to see whether have margins bottomed. Have we been through that misery the last 18 months, and we're now going to see them coming out the other side? And they'll come out the other side. Maybe revenues fall away, but maybe companies have been extra diligent in cutting costs quickly, and so you'll start to get restoration of margin. And so we're on the lookout for that. So we'll see, but it is playing out like any other cycle. I guess the RBA is a little behind the rest of the world. So I guess the pundits would suggest we've got another hike probably in us and possibly two. So maybe we don't see. I mean, my personal view is that the US will stay higher for longer, and we won't get a cut as early as March, as people are suggesting. It's probably closer to June-ish. And I think Australia follows a little later. So maybe we're August before we see something. I'm just thinking out loud, of course. Don't hold me to these dates. And so the moment there's a view that we'll start getting some interest rate relief, that'll also have positive effects for corporate profitability. So there are a growing list of positives you can put on the table. I guess 6 to 12 months ago, you were sort of scratching around to find them.
Yeah. Ben, you mentioned AGM season. Are there any companies that stand out from the meetings or the presentations that you and the team have heard from that you felt delivered less worse than feared updates, or were particularly handling it well? Are there any anecdotes that you can share with us?
Oh, look, I think we always target quality names. We love investing in good quality industrial names with beautiful operating franchises. Breville and Boral came out with, certainly Boral had a good update. Look, Ridley had a really impressive update. So I feel pretty good about the prospects for Ridley. And then, I mean, they're the ones that sort of stood out. To be honest, there were a few disappointing ones, but Ridley's a stock that the Eley Griffiths Group own and have owned for some time, and they're doing pretty well everything they said they'd do, given the restrictions and the impacts on their operating environment. So I think it's safe to look at the AGM season as a whole, and you'll see that on balance, Australian corporates updated the market quite favourably.
Ben, in discussions past, you've talked about how you like to think about what your portfolio setting wants to be, get positioned and hold that line for a period of time. And you've sort of talked about your views on what's happening with rates and where we might be. Could you talk me through some of the sectors that or the types of companies that you want to own as we head into the environment that you've set out for us in 2024. And maybe you could take an example from something that might feature in your mid-cap fund and maybe something down the micro cap, down the smaller cap spectrum. But, what sort of things do you want to own in that sort of the slightly higher interest rate environment, but as things start to slow down a bit?
Sure. Well, look, as I said, we are naturally attracted. We're drawn to good quality businesses, and so you should expect to see good quality names that are probably household names to everyone listening to the pod today. Monadelphous, a name like that, which is a leader in mining services. ARB Corporation is another great example of a homegrown business that's taking an auto product to the world with great success, and that's a stock we've owned off and on for years, and it's in the portfolio now. So you'll nearly always see those sorts of names, the Brevilles, the Borals. Look, we also from time to time we'll own resource names, and we'll own resource companies not because we've got necessarily a bullish view on a commodity or not, but we actually own them because we happen to believe their growth story, and we believe the undertakings that management have are correct, and that you'll see a great earnings growth story. And Capricorn Metals and Genesis Minerals are two examples of resource companies that happen to be in the gold space. They've each got their own modus operandi as to what they're trying to achieve ultimately. But ultimately, it's going to be diversified assets. It's going to be production growth. It's going to be profitable growth. It's going to be potentially exploration upside. But generally, in the case of resource stocks, and Karoon Energy is another one that you'll see amongst Eley Griffiths Group holdings. That's another example of a business that's being methodically put together and built for the long term with very, very sensible management. So they're the sort of stocks that you'll see in the portfolio. And as I said, there'll also be some caution with us around stocks who we think their operating margins haven't bottomed. You'd expect to see stocks like Auckland International Airport and Worley. I mean, Worley's a great example of a engineering services group that provides services to the hydrocarbon industry, but it also provides valuable services to the renewable space and are doing great work. Naturally, the stocks that are in our emerging company portfolio will be different to those that are in the mid cap portfolio. But stocks like Audinate, Temple & Webster, and Codan. They're the sorts of businesses that take pride of place in the portfolio. So as you can see, it's a sensible portfolio. We have strict rules around the number of stocks we have. We keep an eye on our cash balances. The last thing we want to do is have a portfolio that all of a sudden has got too much cash when we've got ourselves a strong tailwind in equities. So so that's we feel pretty comfortable about how the portfolio is positioned for the market we see coming up, Jimmy.
Just on Boral, Ben, name you called out there earlier. If you look at the narrative around that, you've got higher input costs. Sort of business that would have been exposed to margin pressure. With labour costs going up, it seems like the construction industry, at least housing, that side of things, looks to be slowing. How do you build the case around a company like Boral that's, over the past few years, actually had a pretty tough time?
Yeah, no. Look, if I took my shirt off now, you'd see the welts on my back from previous outings with Boral. Look, I think I can almost name the 5 CEOs that have preceded Vik. So I'm well aware of, I guess, historically the failings that the business has endured. Yes, but Boral today has a new CEO, a CEO that we're well familiar with, and Vik Bansal. And Vik, we first invested alongside Vik when he was the CEO at Cleanaway. And we formed a very early view on Vik when he was at Cleanaway, and he had a turnaround. He had a genuine repair job on his hands at Cleanaway, and I think he arrived, in fact, almost certainly he arrived at Boral with a similar job to reset the business, and he's doing a good job. So it's less about the cycle which of course is providing some headwinds for everyone who's involved in construction right now. But it's probably more about self-help and bringing in some proper operating disciplines, whether that's divisional P&Ls, whether that's making sure you've got the A team in place, and which they may or may not have had along the journey. I think it's self-help. On the case of Boral, it's putting that business in the sort of match fit state that it should always have been in, and Vik's getting underway doing that, and the market has responded accordingly. So yes, I mean it'd be very easy for me as a seasoned investor to just simply switch the stock off and not even open the folder, given the history, and the history has gone from times of misery to times of sheer monotony. Today, Boral's become a quite exciting business with an exciting management team, and if the cycle turns, we should see some good times for Boral. Just disciplines generally in an industry that is renowned for poor practice and poor discipline. I think Vik has already made some great strides there. An exciting story, and honestly, if you'd have asked me 3 years ago whether I'd even be talking like this regarding a building material stock, in particular Boral, I'd have literally asked you to stop the interview now. We couldn't go any further. It's quite a revolution that's happening there.
Well, Ben, I want to stay on we'll dig into some unloved parts of the market, because one of the things that we've seen, and REITs has been a classic example where investors have not wanted to touch the sector with a barge pole. Concerns around debt repayments and leverage, and then you've got some of the macro factors around what's happening in office, etc. Keen to know from your perspective, do you look at some of these max distress opportunities? Because I think some of the comfortable names or the well-run names are the obvious place for investors to go. But at a point like this where companies have been pushed to the limit or pushed to points of discomfort, and there's some uncertainty and grey areas, that can also present opportunities. So I'm keen for someone that's been through multiple cycles just to is that an area that's interesting to you, finding some parts of distress where the story might not just be as bad as people expect?
Look, certainly. And one thing I've learned too, James, there's no prizes. There's no prize for being first there. You can identify a favourite REIT, and then it could take 18 months before we actually begin to see the bond market behaving as the right backdrop, then the company doing what it needs to do, and whether it's delevering or addressing valuations. There is guaranteed to be no prize for us being first there. But that doesn't mean we shouldn't be looking. It doesn't mean we're not looking, and it doesn't mean we're not taking a ton of meetings around these sorts of distressed sectors. So REITs is a good example. We don't feel like we need to do something yet, to be honest. But certainly REITs are an obvious place where some money will be made at the right time. The other area where there is some distress, and there's certainly some, there's no distress, I don't think, but there's certainly some angst around it, of course, are some of the consumer finance names. You know, Judo joined the boards not too long ago, and it's really been one-way traffic since it IPO'd, and probably the same with Liberty Financials had a tough investor reception, Latitude and Pepper Money. So these are really solid little business franchises that are well managed in the main, but are just too pointy end for investors. Now, we're keeping an eye on them. We're doing the meetings. In some cases, we do own one or two of them, and we might even be nibbling at one or two of them. But at the end of the day, we do need to recycle our portfolio, and we do need to buy stocks and sectors that are out of fashion. We just need to be very measured as to how we do that. You can be a long time wrong buying a REIT 12 months early. So we just need to be measured on that. But certainly part of our business as a fund manager is recognising pockets of excess value and switching the proceeds into pockets of relative undervalue. And that is the name of the game. Rest assured, that's what we do every day. And
what are some of the things that would need to happen for you to start to, for those unloved sectors? Is it an easing in the interest rate environment? Is it them renegotiating their debt? What are some of the things that get you closer to wanting to own those companies?
Yes, well, it's certainly that. It can be a more favourable interest rate backdrop. It could be a company deciding to address the market's valuation concerns, that properties on balance sheet aren't being held at the appropriate valuation. It could be addressing that. It could be all of a sudden forming an opinion that the consumer perhaps is in better shape than we might have thought. It can be as simple as really thinking that industrial property's been a boom area and it's done particularly well. You might frame the opinion that the tremendous rental growth that industrial parks have enjoyed, maybe that's coming to an end and maybe it's time to buy office again. Heaven forbid, when people start heading back and returning to the office. So look, we're on the lookout for those sorts of themes. It will be invariably the restoration of consumer confidence, no doubt about that. It'll be a general improvement in animal spirits around the operating environment for owners of property. And it'll also be balance sheet refreshes. In the case, often the low is marked by a major equity raising to cleanse a balance sheet, or a major acquisition where an operator steals an asset from another operator that's in distress. That can often be the flashpoint for a revival. So all of those things we're sort of looking for, we're not really seeing just yet. So we don't. We can be patient, I think, with some of those sectors that are under a bit of pressure, and also we do keep an eye. And I mean, I'm not embarrassed to say it. Dare I say, maybe a couple of competitors will be tuned in on the pod. But you know what competitors are up to too. If we have some competitors that we rate highly, which there are many, all of a sudden deciding to move into REITs or moving into a number of these consumer finance names, it might sort of spark something with us that maybe we need to go and have a look at them. So we don't necessarily follow what our competitors do, but I like to keep an eye on what they're doing because they get a few right too.
Yeah. Ben, we're going to get into our regular questions in just a moment, but I do note that Eley Griffiths Group has recently welcomed a new strategy to the family. Not that long ago, you went down the market cap scale from your core small caps offering into emerging companies. Now you're stepping up into the mid cap part of the market. What's the appeal of mid caps for Eley Griffiths Group?
No, you're right. I mean, well, the logic for it is, for us, has been compelling for some time. 28 of the 50 stocks that live in that mid-cap space we've owned before. Okay, so we're very familiar with the business model. We're very familiar with management. We think we know what we're going to get if we choose to own them. It's logical in many cases that we've surrendered some of these names. Unfortunately, we've had to surrender these names, but it's logical that we can be able to own these stocks and buy them back as they move up the market cap tree. So we've been sort of a forced seller given the rules of how the small cap product works. It's a shame to let them go. So we've had a chance to get back on and back involved in companies that we know and are very fond of. So that was somewhat of motivation. The mid-cap part of the market's been sort of that quiet sweet spot that just year in, year out grinds out nicely. It's a part of the market that is so much a part of how we do things, and yet we haven't actually had a retail product, an equity product for people to invest in. So it makes sense. Our skill set's there. There's strong familiarity with the businesses. We know that part of the market to be a sweet spot. And in a cyclical sense, the mid-cap sector, mid-cap industrials have derated about 45% on our numbers back to around 15.5 times. And that brings them bang in line with the ASX 50 industrials. So you've got mid-cap industrials as cheap as large-cap industrials, which is ridiculous given the overwhelmingly more bullish growth prospects for mids versus large. So we think mid-caps have gone on sale, and that's completely overdone. It's a part of the market that holds great appeal. There's a significant resource component to that part of the market, of which we have some great skills in. So it's an area we need to be in. You're right. We start with smalls. We've gravitated down the market cap tree. We've got a successful product there, and we think we know our way around there. This really rounds out the offering, and I think and rounds out our skill set. So that's the rationale for doing it. and we launched very recently, and we've got to say the reception's been quite good.
And Ben, what were some of the early holdings that went into that fund? You mentioned it launched recently. What's big in the portfolio?
Yeah, well, we've been big fans for a long time of car sales, or Car Group as it's known now. So that no surprise that Car is in the portfolio. I touched on Genesis before. I touched on Boral, GQG. We're great fans of that investment management model. And Auckland International Airport and Worley, just a handful of names that have gone in there. And of course, there are many more. There's a decent tail of stocks there, but they're they're some of the bigger names at the top of the portfolio that we believe fit the bill, that come out of our process looking good, and we believe will serve unit holders well.
Well, hopefully it has a good run and builds a record similar to that of the small companies fund.
Listen, I'll send you a PDS after the interview. No problems.
All right. Well, at that point, why don't we jump into our 3 regular questions? The first one, Ben, what's the one thing that you think investors are getting wrong or missing in today's market?
Yeah, well, it's I think what investors regularly make mistakes of, and they're making, and they have made it in this market, is when you've done the work on a stock and you've built your conviction around the model. You've gotten comfort with management. You're convinced the board are great stewards and great shepherds of the business, and you've scoped out the revenue opportunity. What you now need to not do is drop the ball, right, and get anxious because the share price is legged down. It's down another 5% today, another down 3%. I think a loss of conviction is easy when you get rattled by what's going on in the press, how the share price is trading. And I think people who've done the work, who are strong believers in a certain stock or business model, and then lose their way. And we certainly saw, I believe, evidence of that towards the end of October, where, as I said, stocks appear to have bottomed, but coming into October, there was somewhat of a give up. So I think we're seeing investors have basically lost conviction at precisely the wrong time, and they'll be buying stocks back. Those very stocks that they had the conviction on, they'll be buying them back much higher later.
All right, let's move on to the next question. This is a bit more of a retrospective, and hopefully you can tease out a few lessons. But I was hoping you could share a win or a loss from your career. Talk us through the gruesome details around what happened, or talk us through the highlights if it was a win. And importantly, what was the lesson that you took from it?
Well, I know you asked me about this before we came in, and I've thought long and hard about it, and I thought I'd do something that most guests probably don't do, and I thought I'd reflect on a loss. And what it taught me. And I'll have to wind the clock right back to the late 1990s when I was managing money, and back at ING, in fact, when I was a portfolio manager there, and we had a substantial shareholding in a company that many on the pod won't even have recalled, but it was known as Discovery Petroleum, and it was a substantial gas producer in the Perth Basin of WA. We owned 6% of the company, maybe even 7%. But the problem with it was a perfectly predictable, well-managed business that traded in a trading range. And I went from 55 cents to 62 cents and back, and between 50 and 60 cents for years. We owned 6% of it. And I remember just being so bored with it and anxious that the opportunity cost of holding this stock was so great. I could be in other things. And the moment the stock broke out of that 50 to 60 cent range, it broke topside and was trading at 65, 70 cents. I sold the lot. I sold them all out and felt fantastic. And I sold them pretty well in one ticket, and which gave me a fright, I guess, after I'd done the business. And the reason that happened was, of course, a corporate raider had turned up recognising the same value that we'd seen, and had decided that they were happy to pay a modest premium to secure a position. And it was Premier Oil of the UK. And they turned up and bought all our stock. And when it was revealed that it was Premier, the stock popped again. And then Oil Search were rumoured to be interested in buying Premier. And I just sat there with my hands on my head saying, I held this stock, this beautiful company, for 3 years. It gave me nothing but angst because it just didn't really go up. It paid a modest dividend, and I sold it at precisely the wrong time, and I looked like a complete fool. Why did I do that? And I guess the lesson that I learned from that was that never sell a stock that's long been inactive just at the moment it begins to move up. There's a reason why that stock is broken out of that trading range. And of course, it was corporate activity, and it was Premier Oil's good fortune to steal that business. I've never forgotten that story. And the moment I see a stock move erratically or unusually out of what has been a boring set of trading circumstances, rather than just react, if I want to sell them, I hold off and seek an explanation. So I think that's the lesson I learned from a loss. And whilst we didn't lose money on the actual position, I forewent some nice gains. I handed them to Premier Oil of the UK. They weren't going to thank me, the British shareholders.
If you're wrong, you're wrong. If you leave it on the table, it almost hurts more.
No, it did. That was an awful, but I learnt. I haven't forgotten it. Not a day. Well, that's not right. I was just saying, not a day goes by I don't think about it. It's not quite that bad. But
you've taken a lesson from it.
It always comes to mind when people ask me what I've learnt in the market.
All right, Ben. Well, listen, this has been great. We're nearly done now. Our final question, just a quick note to listeners out there. This is a hypothetical question. We're obviously not advocating you put all your money into a single stock, and Ben runs carefully risk-managed, diversified portfolios. This is meant to be an exercise in long-term thinking and also a bit of fun. So, Ben, for our final question, if markets were to close tomorrow and stay shut for 5 years, and you could only own shares in one company, which company would that be, and why would you own it?
Well, I thought that was a great question, James, and you emailed me the other day, and so I'm going to ask you that question and give it your best consideration. And I thought about it long and hard, and I went through a whole bunch of shortlisted names, and I've landed on a New Zealand stock of all stocks, and it's Main Freight. And Main Freight, many of you have seen the trucks rattling up and down the highway. It's an integrated freight handling, warehousing, logistics operator. Not that old, really. Established in 1978, and it's a superbly managed business that is, without being cliched, it is taking on the world. Operates in, I think it's 25, 26 countries, with the most seasoned management team, and they are basically hell-bent on taking the Main Freight message and the Main Freight way to the rest of the world. And they're getting great traction. Now, they're big in Australia. They're growing in Asia, where they've hardly really got started. They've just turned soil in India, which is going to be an enormous opportunity, but they've only just landed there. In the United States, they've turned up. They're getting a great reception, and their revenue line's about $1 billion. The biggest competitor in their space is a revenue line of $20 billion. So you can see there's some market share and some volume to be had. They're opening up they're in Europe already, but Europe's opening up to them. And they've got a balance sheet that's net cash. With the management team that you've got there, which is amongst the highest caliber, I think, in Australasia, with the growth trajectory that the business has, and they've only made one acquisition. The last acquisition they made was back in 2011, which I think was a little business in New Zealand, I think. The rest of it's been grown organically. Speaking to the CEO a while ago and asked him about the number of board meetings you have and how do you conduct them, and he said that a typical board meeting goes for about 3 or 4 days, where they literally go from centre to centre and review the operations of the business. It's an extraordinary business that pays dividends. If I had to do exactly that, Jimmy, and basically buy the stock and then hibernate for 5 years, I know while I'm sleeping, the business would be paying dividends and growing organically as you'd expect it to, and with all the management disciplines you want to see. So that's my stock. Hypothetically, I'll see you in 5 years, and we'll see where how its fortunes unfold.
Well, hopefully it won't be 5 years till we next catch up, Ben. But Main Freight, definitely one to keep on the radar. To all you listeners out there, I hope you enjoyed that chat with Ben Griffiths, who's the founder and portfolio manager at Eley Griffiths Group. Ben, thank you very much for coming on the podcast. Happy 20-year anniversary, and all the best with the new fund.
Thanks, James. Thanks for having me on today. I've really enjoyed it. Thanks, mate.